All right, here we go. We are getting started. Three, two, one. We are live. I'm Mitch Goldberg. How's everybody out there? I hope everybody can hear me. And if you have any questions about the market, about the content that we're talking about, definitely hit me up in the comments. I love hearing from you. It's the best part of what we do. Uh, a thumbs up, give it a like, subscribe to my YouTube channel, do all the things that all of the social media and YouTube influencers ask you to do because it does help me grow my audience. Um, I sponsor these things by myself. In other words, I don't have a sponsor. I lay out all the cash for the equipment to make this happen, the time, and believe it or not, there is a lot of equipment, and when the equipment works, it's really quite rewarding. Okay, when the equipment works. So we've got a couple of things to talk about today. Big rally today in the stock market, and it just happened. It happened just when we needed it. So let's roll a quick introduction. We've got a couple of screens going on over here. We'll roll the intro. Just put the banner up there. We're gonna roll the intro. We're gonna talk about this. It's just a contrarian bounce. It was just oversold conditions, too much negativity. I mean, all we talked about over the weekend was the prospect of nuclear war with Russia. You'd think that would be impossible for the market to go up, but we got through it, and the market rallied very, very hard. Here we go. All right. Thank you so much for joining me. We're just getting started. We had a huge rally in the market today. It's a really big rally just when we needed it. We hit year lows last week, 52-week lows, year low. Gave up just about all of the stock market gains that started with the pandemic. Many stocks are well below uh, where they were, when the pandemic started. Many stocks are back to 2019, 2018 levels, and many are even lower than that. Uh, Pretty negative out there. So what's the deal? Why the market rally today? We had so much negativity. We're going into an earnings recession, or earnings are about to fall off a cliff. Manufacturing down, inflation up. The war is turning around into Ukraine's favor against Russia. So there's nuclear saber rattling. We never thought we'd see that. I mean, at my point, I was a child of the 80s, and I went to middle school, high school, and college all in the 1980s, where, you know, there was a Cold War, and you you learned how to live with the prospect of two nuclear powers going to war, but it was always understood, nah, they'll never do it. So you didn't really worry about it. Nobody ever said they're going to use nukes until now. In this day and age, we have a crazy dictator, unfortunately, who is actually talking about using nukes because it turns out the vaunted Russian military is still a 1950s Soviet era fighting force. It's really, I think the whole world is shocked at how uh, bad the Russian army and the whole Russian military complex really is. It's like we thought that this was like some kind of elite army, the crown jewel of Russia. And it's like everyone is like, wow, what the happened? And they're probably thinking, holy shit, the US is so much more superior than we even thought because we're not even fighting in Ukraine. We're just giving some guidance, some intelligence, a lot of guidance and intelligence and weapons. But we're helping an underdog achieve a victory against one of the most powerful militaries in the world. It's really remarkable, this whole thing. I'm kind of infatuated with the whole story. I can't get enough of this stuff. I read about anything new that comes up with Ukraine and Russia. I read about it constantly. I'm like an expert on this at this point. But anyway, markets up against so many odds and so much negativity. And that's why I say it's a contrarian rally. Where things get too negative, it means sellers have exhausted themselves. So even if you only have a few buyers left, it's still more buying than selling. But once the market starts to go up a little bit, then someone else will say, wait a minute, maybe I should be buying too. And then someone else will say, before you know it, everybody's buying, stocks are up. There's a number of uh, pros out there who have turned bullish, like Doug Cass of CB's Partners, a couple of other people have turned very bullish all of a sudden, said we are oversold. Now, what caused the market to go down in the first place after that we went down into June, we had that July rally into early August, we've been going down ever since. Well, what happened today is that interest rates finally backed off. We're going to take a look at that. Interest rates went down, money went out of bonds, it had to find a home, it went into stocks basically. So stocks took off. Bond yields went to highs, 15-year highs, or yields that we haven't seen in like 15 years. And just when everybody decides to throw all their money into a 2-year treasury and hibernate for the next 2 years, all of a sudden yields are down, stocks are up. And this is why I like to say, don't make all or nothing investments. Stocks, bonds, cash, whatever else you want to put in your portfolio, real estate, diversification, it's important. It doesn't necessarily protect your overall portfolio from going down in a generally down market, but it does help mitigate risk. And if you mitigate risk, it means you can recover quicker. So that is what's going on in a nutshell. Yields came down, market climbed a wall of worry. The yields coming down was the spark. The wall of worry, Russia, Ukraine, inflation, OPEC Plus might cut up to 1 million barrels per day of oil production, which would push oil up because they're worried that oil is coming down too low again. So much to be negative about. That's what pushed the market down. But the spark that finally got someone to get in here and buy after the sellers have exhausted themselves was bond yields and treasuries going a little bit lower. We spent some time the last couple of weeks talking about short-term treasuries, 1 year, 2 year, 18-month, 6 month. I was talking about laddering your treasuries, 6 month, 12 month, 18 month, and 2 years. We did quite a bit of that. It wasn't the only thing we did. It never, ever, ever, ever said you should get out of all of your stock money. Just I looked at treasuries, whereas it's a good place to park some of your cash. Because I held off on buying bonds because I was concerned that interest rates would go up and bonds would lose money, which they have. So now I'm sitting on all this cash instead of bonds. I decided to put some in treasuries and earn some decent yield now. There are a lot of stocks that are paying 3 or 4% dividend yield now. If you're just in the market for your 4%, you'd rather get 4% from a treasury without the volatility of the stock market as opposed to buying a stock with a 4% dividend yield. And one of the big problems in this market is that there are an awful lot of baby boomers. I speak to them all the time, not the ones who are my clients, mind you, but I'm asked about the market all the time when I go out, and boomers are always saying, when's the market going to come back? And I know exactly what y'all did. I know what you did. Baby boomers plowed money into the stock market more for their particular age than any other time in history, more than any other time in history. Okay. To get dividend yields out of stocks. Oh, it pays a 2%, 3%, 4% dividend yield. I've got to get that. When you're talking about volatile securities like stocks generally are volatile. So if your stocks go down 25% and you're getting a 2% dividend yield, do you feel better because you're really only down 23%? When the person who's looking for yield on their investments is probably the kind of investor who didn't even want to take that much risk in the first place. So these are the things that we do here. I spend a lot more time telling people what not to do with their money than I do telling people what to do with their money. Okay. So These are some of the things that we talk about here. Be the boss of your money. So I appreciate you watching the show, by the way. And if you are enjoying what you see, if you're learning from it, give it a thumbs up or a heart or an applause, depending on whatever reaction is available to you on whichever channel or social media platform you're watching from. And again, for you YouTube people out there, thank you so much for joining me today. If you're not a subscriber already, please subscribe. I like to post really good content. And when I see you guys subscribing, it does give me some encouragement to keep going. Questions in the comments, folks. All right, so let's take it to the tape here, okay? Dow up 765, up over 2.6%. NASDAQ up 2.25%. S&P up almost 2.6%. Gold is up a little. Oil had a decent bounce back again in the news that OPEC might cut some production. The 10-year, which was over 4%, is only back down to 3.63%. You'll probably see mortgage rates go down over the next few days as well, if you haven't already seen that today. The VIX came in a little bit, all right, back to 30. This is the most important thing we're looking at today is the yields. You see these? You saw this red? These little pluses is nothing. That's a 3-month and a 6-month. But bond yields from 1 year to 30 year finally came down. It's a big deal. And that's the spark to get people invested. The yield on the 10-year, okay, the high was 3.8%. So yields came down pretty good today. And I think that's making investors feel a lot better. Everything we're looking at is prices. There's a pretty strong belief developing that inflation is starting to come down. It's not just oil. I know where I live, when you drive by a gas station, gas is $2 and change. High twos, but nevertheless, firmly under 3. I don't know how it is by you, but that's where it is by me. Not every gas station, but a lot are showing $2 and change for gas. But used car prices are coming down. I think one of the big used car companies, CarMax was it last week? That stock plunged because of less demand. It appears that people have gotten their fill of cars, and they've gotten their fill of houses, and they've gotten their fill of everything that's made. They're right now getting their fill of experiences, like going out to dinner, going on trips. And even that looks like it's starting to come to an end, because if you look at stocks like Carnival Cruise, I don't like to talk like that. If you look at Carnival Cruise, if you look at Southwest Airlines, if you look at Planet Fitness, these are the reopening stocks. These stocks are all at their year low. And yet industrial stocks are the ones that are actually, and bank stocks are starting to go up a little bit. There's a message in the market there. Let's take a look at all of the sectors today. So energy was the leader of the day, up over 5%. Keep in mind, energy has come down a lot. 93 was the high. Before today was 72. The XLE, that's the big ETF that tracks the energy sector. So energy did have a big drop. Building materials, nice, but basically everything was up across the board. Industrials, every sector was up. Almost every stock on my screen was up. All right. What have we here? This is a lot of nothing. This is used car prices going back a year. And you see here, they've peaked. But it shouldn't take away what's been happening with used car prices for the last 5 years. So we know we're seeing a little bit of a dip down here. But let's keep in mind, I would be a wonder if we went back to where we were 3 or 4 years ago in car prices. Just helping you keep it in perspective. I think that's it for the share screens. So that's what's going on. Yields started to come down. Stocks were oversold. Pessimism in the stock market running rampant. I spoke to a lot of clients at the end of last week, and the negativity was so thick you could cut it with a knife. So here we are in a big rally. Do I trust this rally? Do I think this is sticking around? Do I think the year lows are in and that's it? We're only going higher. I really don't know. I know you want me to tell you we're at the bottoms, and it sounds so appealing to be able to say that we've reached the bottom in the stock market, and from here on in we're going higher. I wish I could say that. A lot of people thought the June low, the low we had in June was the low. Let's not um, waste time deciding. Let's not waste time deciding if the stock market has reached its low for the year or not. Let's spend more time focusing on investing regularly in quality for the long term. That's what's going to make it for you. It's so easy. If people keep making these dramatic calls, we hit the low, we're going lower. We've got another 20% to go down. We've got another 50% to go down. People love to make these calls. Remember when oil was $120 per barrel, went to 130, then everybody was saying, "Oh, it's going to be 150 to $200 per barrel," and it went right down to the 70s. Eventually, someone will make the big dramatic call, and they will have some notoriety. They'll be on TV, and they'll be the person who called it last time, and then they go away. I can think of so many people in the market who've made these big calls. They happen to be right. But remember, even a broken clock is right twice a day. Think about that statement. A broken clock is right twice a day. So let's not get carried away with, are we at the lows for the year or not? What you really should get carried away is to say, I think XYZ company is a really good company, and the price that it's come down to makes it compelling enough for me to want to own that stock for the long term. That's something that's worthwhile. Don't say, well, I really don't want to hear you say, I think XYZ stock hit its low. We're going to buy it at its low. Like, only you get to buy stocks at their lows. Like, if a stock's not at a low, you won't buy it. You don't know what a low is. People act like a year low or a 52-week low for a stock or an index. People act like that's like the floor. No, these could go right through the floor and make a new floor. By the way, you know what I'm about to say, right? Oh, I've got to say it, though. You can't invest directly into an index, but you could invest in a security that tracks or mimics an index. Boom, I said it. There you go. All right, so that's the whole ball of wax. Tina's out there. Tina, thank you so much for joining me, Tina, and thank you so much for sharing my content on Facebook. I really appreciate it, and I'm so glad that everyone and everything by you I'm glad everything's okay by you. Tina is on the west coast of Florida, not too far from ground zero, but where she lives, she seems to have gotten through unscathed. Thank God. All right. So that's about it. I'm going to get going. I really appreciate you guys joining me, and I'll see you tomorrow, and have a very good